Welcome to Ascend Your Mind, and welcome to the millions of you watching right now. Today, I want to talk about gold. Not gold through the lens of fear, not gold as a story about confiscation or sensational crisis headlines, but gold as it truly operates inside the real monetary cycle of the global system. If you open social media right now, you'll see two very familiar narratives. One side says, gold is entering a new supercycle, the Fed is about to restart QE, US debt is out of control, and anyone who doesn't buy gold now will regret it. The other side says, gold is already too high, interest rates are still elevated, the dollar remains strong, and gold is due for a deep correction. Everyone has data, everyone has charts, everyone has experts backing them. But what's the outcome? Most gold investors still buy emotionally and sell in panic. Not because they're unintelligent, but because they don't know which season gold is in within the monetary cycle. In video 38 on this channel, I made one thing very clear. Assets don't rise or fall because of stories. They rise or fall because of large capital flows. Gold is no exception. There's something crucial I need to clarify right at the start, because without this, gold's behavior will always seem confusing. Gold does not operate like stocks. Gold does not operate like Bitcoin. And gold certainly does not operate like real estate. Gold is a monetary asset. That means gold doesn't need growth. It doesn't need earnings. It doesn't need innovation narratives or technological disruption. Gold's value comes from one place only. It reflects the state of money within the system. When money becomes abundant, gold is sought. When money becomes scarce, gold is ignored. And this is where many investors get it wrong. They think the more unstable the world is, the higher gold must go. That's not entirely true. The world can be extremely unstable, but if money is being drained from the system, if interest rates remain high, if liquidity is tight, gold is not guaranteed to be the preferred asset. Because in those moments, what large capital needs most is not protection, it's cash. Many people say, gold is a safe haven, so shouldn't you always hold it? That statement is only half true. Gold is a safe haven, but it is not always the preferred safe haven, because the price of gold is not determined by individuals buying a few ounces. It's determined by central banks, investment funds, major banks, and global financial institutions. And those institutions always act according to the monetary cycle. Winter, when money is expensive and liquidity is drained. Winter for gold begins when money becomes expensive, when interest rates rise, when the Fed drains liquidity, when the dollar strengthens, when credit tightens. During monetary winter, there's something most people don't see. Central banks and large institutions do not panic the way retail investors do. They don't sell gold because they dislike it. They deprioritize gold because they need balance sheet flexibility. When rates are high, when the cost of capital is expensive, holding a non-yielding asset becomes an opportunity cost. That's why during tightening cycles, gold often doesn't collapse, but it also isn't embraced. This is where many investors feel disappointed. They expect gold to surge when risk rises, but they forget a critical condition. If risk rises while money is not cheap, gold has no fuel to fly. In this phase, the top priority for large institutions isn't hedging, it's liquidity. They need cash to service debt, stabilize balance sheets, and reduce systemic risk. Gold isn't the first choice here, not because it loses value, but because it doesn't generate cash flow. When money is expensive, cash and short-term bonds are more attractive. That's why during aggressive tightening cycles, gold can move sideways or correct, even while macro risks remain elevated. In winter, the right action is not aggressive gold buying. The right action is maintaining reasonable exposure and avoiding mistimed expectations. Spring. When the worst is behind us. Spring doesn't begin when things get better. Spring begins when things stop getting worse. The Fed doesn't need to cut rates yet. It only needs to stop making money more expensive. Liquidity stops deteriorating. Forced selling fades. Large institutions begin looking ahead. In this phase, gold starts being reconsidered, not as a speculative asset, but as a risk-balancing tool. Buying gold in spring is uncomfortable. The news is still negative. The media still focuses on high rates. Skepticism remains widespread, but markets don't wait for good news. They only need conditions to stop deteriorating. This is the phase when gold becomes interesting again. Quietly, almost unnoticed, Central banks begin thinking long-term, not to speculate, but to rebalance reserves. Gold doesn't spike here, but it becomes resilient. It becomes difficult to push meaningfully lower because selling pressure has eased while long-term hedging demand begins returning. This is when gold is bought not because of headlines, but because of future systemic risk probabilities. Long-term investors begin accumulating gold with discipline, not because price will surge immediately, but because the probability of being wrong has dropped significantly. Summer, when money becomes cheap and confidence returns. Summer begins when money truly becomes cheap, rates fall, liquidity opens, credit expands again. In this environment, gold's role shifts. Gold is no longer just insurance. It becomes a measure of confidence in fiat currency. When governments print aggressively, when debt balloons, when real rates turn low or negative, holding cash becomes a losing proposition. Gold doesn't need a story in this phase. The monetary environment is the story. That's why during major easing cycles, gold doesn't just rise, it establishes new price regimes. Central banks and major funds begin viewing gold not merely as protection, but as preservation of purchasing power. When money is cheap, holding cash is punitive. Gold becomes a shield against inflation and currency debasement. That's why during aggressive easing cycles, gold performs strongly. From 2009 to 2011, following the global financial crisis, the Fed launched large-scale QE. Gold surged and reached new highs. In summer, the right action is not chasing price. It's holding positions built earlier and managing risk as momentum overheats. Autumn, when inflation returns and money stops getting cheaper. Autumn is the most deceptive phase. Prices are high. Confidence is strong. Everyone talks about gold's safe haven role. But beneath the surface, inflation returns. The Fed can no longer ease. Money stops getting cheaper. When money no longer becomes cheaper, gold's upside momentum weakens. Meanwhile, speculative positioning is elevated. Leverage is high. All it takes is price stagnation for profit-taking to begin. Selling in autumn is the hardest decision because gold is still popular and sellers are always accused of lacking conviction. But professionals don't sell because they know the exact top. They sell because they understand capital flows have shifted. In conclusion, gold does not rise because of fear. Gold rises when money is cheap and confidence in fiat weakens. Gold does not fall because it loses value. Gold falls when money becomes expensive and liquidity is drained. Gold is not for those chasing headlines. Gold is for those who read the cycle correctly. If you understand which season we're in, you'll stop asking, "Should I buy gold right now?" and start asking, what is the most rational action for this phase of the cycle? On Ascend Your Mind, my goal is not to spread fear, but to give you a cycle map so you're not lost in noisy narratives. In the next video, I'll break down where the U.S. currently stands in this cycle and how gold should be positioned going forward. If you want to keep following that perspective, stay with Ascend Your Mind, because in investing, the winners are not the fastest reactors. They're the ones who move with the cycle and have the patience to let it work.